Welcome to Notepad. I'm your host Ibrahim Sani, back in the hot seat for the first time after suffering COVID. How about that? The coverage that we're going to do for this evening is, of course, we have two gentlemen dialing in from across the world. We have Bashar Al Natoor dialing in from Dubai, as well as Alastair, of course, dialing in from London. We're here talking about the economic recovery and whether or not it can sustain the Islamic banking sector growth, not just in Malaysia, but perhaps scan around the world as well. Bashar Al Natoor is, of course, the Fitch Ratings Global Head of Islamic Finance. Alastair Sewell, making his first appearance on the show, is the Senior Director and Regional Head of Fund and Asset Management and Asset Manager Group for APAC as well as EMEA region. Gentlemen, let's start off with the overview. Maybe Bashar, you can start off with some of the elements coming in from the COVID-19 pandemic. Many of us are now moving into an endemic phase, Malaysia included. Perhaps you can do a quick recap into the health and status of the Islamic finance scene before we jump into the Islamic Fund later on with Alastair.
Thank you very much for having me, and glad to see you in good shape, recovered, and fully back. I think the Islamic fund industry, and maybe just to put it in a few words, I think it was not really cocooned from what's happening during 2020 and 2021. It had its own specific areas where in some areas it did better, in some areas it did worse, but in general, I would say, and across sectors, so whether you're talking about Islamic banking or takaful or sukuk or the fund management industry, the impact was similar. But one thing that we've noticed that in terms of growth, the Islamic banking industry, the Islamic takaful sector, and even the fund industry, which we'll discuss, I think, with Alastair on details, the growth has been, in general, far bigger and faster than the conventional one. That is a continuation of the trend that we saw before. So it's not like a new trend. It is something that we've seen even before the pandemic, and that trend did not really change during the pandemic. And we don't expect it, honestly, to change even in the future. So I think that is the key summary of that. If you look at the sukuk industry, we've seen growth in the sukuk industry in general in 2021. In terms of actual issuance, it maintained its status in terms of the top 10 countries, around 25% of total issuance. We saw the Islamic banking industry doing similar, I would say, behaviors when it comes to growth. Maybe I'll share some numbers about Malaysia specifically, but also it shared a similar level of pressures. Differences were in some areas where you had a bigger exposure, for example, for real estate or tourism compared to between conventional and Islamic, where it acted to the favor of one against the other, or if you had a larger retail deposit funded Islamic banks in some of the markets where that helped these markets, or in the case of Malaysia, you had the household loans in general, which behaved in a better way compared to the other one, and Islamic Bank had a bigger share of that. So as you can see, it's really to do with exposure rather than with the actual offering. Yes, Islamic banking industry had in its arsenal already the ability not to charge delinquency interest because that's not allowed. So they did not charge delinquency profits, did not have a problem of not doing that, but it did not really cocoon the industry, neither this or the industry went, I would say, for example, in exercising its profit and loss abilities when that is a contractual obligation. So we did not even see that. In Malaysia, maybe, and a quick summary on that. So if we look at the sukuk market, the sukuk continues to represent around 63% of outstanding local currency bonds and sukuk. So sukuk is the dominant one. If we look at the banking industry, the financing stands at the end of the year to around 35%. And now there is another ambition and another target put by the roadmap. Let's see how successful is that. And the family takaful is more than 41% of the industry. And in all of these sectors, the growth of the Islamic segment was higher than the conventional one.
Okay, let's bring in Alastair in this as well, because Islamic fund management also looks at rather a steep decline globally. I don't know how things are going to shape up for this year. Maybe you can do a quick recap on your scene as well.
Yes, of course, and it's my pleasure to be here on the show for the very first time, and thank you for inviting me. So in fact, the Islamic fund management industry has been a real success story over the last few years. If you look at total assets under management globally in Islamic funds, they have grown at a faster pace than conventional funds. And to put a few numbers on that, Islamic funds worldwide grew by about 84% over the last 3 years, compared with about 68% for conventional mutual funds. So there really is quite a strong growth rate there. It is important, however, to put that in context. We estimate total assets under management worldwide in Islamic mutual funds at about $130 billion, which is growing. It is a sizable amount, and yet the entire global mutual fund industry is in the order of 68 trillion. I'll repeat that, trillion dollars in assets under management. So there is a material difference here. There is a low base effect perhaps supporting the growth of the Islamic fund industry, but that growth rate, that 84% growth rate over the last 3 years is much faster than conventional money, mutual funds. So therefore, there is strong demand for this fund type.
Gentlemen, the recovery phase that many of us are undergoing through right now has seen, stuttering results. Malaysia right now, for instance, has over 300,000 people active COVID positives right now. Though, death cases have declined considerably, and if we can classify illnesses on severity from category 1 to 5, many of us, in fact 98% of us, are in either category 1 or 2. Now this of course translates to how the business and the economy is actually going through as well. We are rather okay for 2022, but not quite there yet. How does this translate into the health of not just the Islamic finance scene, but of course the Islamic fund management as well?
Okay, maybe I'll take the Islamic finance and then we'll zoom into the funds. So I think all the questions that you posed are legitimate. So at the end of the day, the way that we're looking at it with the recovery of the economy in general, we expect that the trend of growth to continue. And here I'm talking about Islamic banks. But let me give you an example on, maybe zoom on Takaful specifically. So the Takaful and the family Takaful actually grew last year significantly by almost 40% in terms of contribution. That's a significant growth. And this is because of the awareness, because of the government initiatives, and because of the environment that we're living in. And that sector benefited, and the Islamic segment of it benefited more, substantiating its share higher. In terms of the Islamic banks, when we look at the MPLs of Islamic banks, the MPLs of Islamic banks were around 1.2 compared to the conventional, which is around 1.6. So yes, it's impacted. And yes, as we see the government protective measures being removed, it is expected to have an impact, but it does not. We're not expecting a spike. We are expecting that even in that side of the equation, that it will be smooth because the government will still leave some of these initiatives. And also, as I've said, that the exposure of Islamic banks to the household and side of the equation more than the conventional, which actually could be a supportive factor. In terms of sukuk, and the way that the sukuk market, in terms of volume, it grew, but in 2021, we've seen the first default of a sukuk in Malaysia, and that is something that is putting pressure. We saw also another default of sukuk in Indonesia. So even earlier in the pandemic, we said that the actual pressure could actually result in a more pressured environment, and that could result in sukuk defaults. We don't expect like a spike because the global default of sukuk in general is 0.25 compared to the total issuance, so it's still small. But we could see cases of defaults in various countries, and that could give us also an insight of how the regulatory systems are going to behave in terms of resolution, recovery, and restructuring of these systems, specifically when it comes to how is the Islamic finance treated compared to a conventional recovery, conventional restructuring, legal system testing, etc., etc.
I want to ask Bashar again. I want to ask you about the asset quality on Islamic finance moving ahead. Do you feel that this is going to be better in terms of the performance against conventional, or do you have a differing view on this?
Yeah, I think it will. I mean, yes, we expect it to continue the trend of having lower NPLs because of the sector that it's exposed to. and the way that the industry reacted in the last 2 years. But that's not something that I would say the trend that we expect globally, because for Islamic finance, because in other countries you actually have weaker underwriting and risk management in some of the Islamic banks. In some of them, you have a smaller Islamic banks that are more aggressive. So I don't think it has to do mostly with Islamic banking industry, but in the case of Malaysia, and because of the exposure of the Islamic banking industry and its maturity level, we expect that it will maintain that level or that advantage, relative advantage compared to the conventional.
Alastair, same question to you. Do you feel that 2022 is going to be a year of mixed recovery? Despite the fact that you say that there could be a huge demand, there is material differences between conventional and Islamic, but even if there is a demand, how do you think that is going to be translated for this year, considering that many countries, including Malaysia, for instance, is still finding our footing back towards recovery?
Yeah, absolutely. I think you've hit the nail on the head there. I think top down there is a mixed picture for the outlook ahead. On the one hand, we have domestic demand. So many of these mutual funds, and here I'm going to focus on Malaysia. Many of these mutual funds are distributed domestically, so they are servicing an innate local demand for mutual funds. And effectively, mutual funds act as a competitor product for bank deposits. And as we've seen in several markets, the savings rate has increased during the pandemic, which means investors are looking for homes for their savings. And that could be bank deposits, that could be other bank products, or it could be mutual funds. So there is this inherent layer of domestic demand. On the other hand, Bashar has already alluded to the fact that there have been some sukuk defaults, although at a low level, but there have been sukuk defaults. So this raises the question of asset quality. Now, if we look at mutual funds in Malaysia, roughly 40 to 45% of assets in Malaysian mutual funds are in equity funds. So clearly, if broader economic conditions, be they global or be they local, if they affect equity valuations, leading to poor performance of funds and therefore a reduction in assets, then that could have two effects. One, the direct effect, by reducing asset values, that reduces assets under management. And there's also the indirect effect, where weakening performance can lead to a loss of investor confidence in the sector, particularly for investors who are perhaps newer to mutual funds and have less experience of holding, investing through economic and business cycles. But this confidence effect could lead to outflows, and outflows in severe cases can lead to mutual funds suspending redemptions or stopping investors from getting their money back, which is an important macro-prudential protection measure, but also very damaging for investor confidence. So perhaps we could say we are at the peak of the cycle. This is the high watermark, and that there is potentially change ahead to the downside.
Alastair, do you think that this is going to be a little bit more pronounced in Malaysia as opposed to other markets, or it's more of the same everywhere else as well?
No, I think the Malaysian Islamic finance industry is more exposed to broader economic conditions, broader economic declines than other markets. The market I'll pick to compare is Saudi Arabia, which is in fact the largest Islamic mutual fund jurisdiction around the world. Incidentally, Malaysia is very significant. It's about 30%, so let's say roughly a third of total assets in Islamic mutual funds. Saudi Arabia slightly pips Malaysia with a little more. But the key difference is Malaysia has this large weighting to equity funds, which are by definition riskier and more exposed to broader business conditions. In Saudi Arabia, the split is much more to money market mutual funds. Almost 80% of assets in Saudi Arabia are money market funds, and these are by definition less volatile investment products. They return less, but they vary in value less. Whereas an equity fund, well, it offers investors upside, but it also offers investors potential downside. So this material difference in the asset allocation is an important differentiator.
Okay, we'll go for one short break before we continue our conversation with Fitch Ratings. Thanks for staying on with us. This is Notepad. I have with me Alastair Sewell, Senior Director and Regional Head of Fund at Fitch Ratings, dialing in from London. We also have Bashar Natoor, Head of Fitch Ratings, Global Head of Islamic Finance, dialing in from Dubai. Alastair, let's pick up where we left off when it comes to some of the markets that you compared and contrast Malaysia with. Saudi Arabia is a little bit better in terms of managing the Islamic mutual funds, but at the same time, every single market, I suppose, does have that risk involved. Maybe we can compare and contrast that with sustainable financing as well as ESG financing. Some of the investors are very particular when it comes to ESG, at least for this year. Do you think that the demand for better products and services coming out from ESG is going to drive not just the recovery of Islamic finance, but generally speaking, finance as a whole?
Yeah, responsible investment has been a major theme in the global investment management industry for a number of years now. To give you an example of this, in Europe at the moment, roughly a third of mutual funds are invested in a responsible format under a specific local regulatory definition. So this is a major theme, and you can see this in other markets around the world as well. In Asia in particular, as we see the rollout and the development of environmental taxonomies, for example, in several markets, we see these as a key part of a regulatory initiative to a broad regulatory push to increase capital flows to responsible investment. And the taxonomies are typically a first step in that direction, which then lead to further downstream regulation directed specifically at mutual funds. So this is certainly a growing trend. But taking a step back, it is also important to think about the Islamic finance industry, the broader Islamic economy, through a lens of responsible investment, because essentially a thematic investment strategy, a faith-based, faith-driven investment strategy, is arguably responsible investment already, and therefore the Islamic finance industry is therefore well advanced. Now, of course, there will be investors who look for additional environmental or social or governance factors when they invest. And there, I think I'll hand over to Bashar to perhaps say a few words about the development of the green sukuk market, which is clearly something environmentally focused investment funds would consider for their investment portfolios.
Bashar, go right on ahead.
Yeah, I think Alastair alluded to a very critical point, which is Islamic finance is by nature is considered by a significant sect as a responsible investment. However, that is not something that the Islamic finance industry, whether on the sukuk side or Islamic finance, has been successful in marketing beyond its traditional Islamic Sharia sensitive investors. But the perception of, for example, so the restrictions on alcohol, the restrictions on the gun industry, gambling, cigarettes, it's already embedded in the Islamic finance. But we did not see yet the Islamic finance industry being able to capitalize on many of these principles on top of its own additional principles like zakat, like waqf, like sadaqah, etc., let alone these ones. But even the common ones, the industry is not yet there to capitalize on that. However, when it comes to sukuk specifically, I think Alastair alluded that there is a significant part of the European and the developed market, international investor are very sensitive about the green or sustainable or transitional investment. And that drove the increase of sukuk that is ESG related one way or another to grow significantly from a very low or non-existence. I mean, Malaysia started a few years back, but I'm talking about the international side. We've seen actually issuances increase in the past 3 years significantly, continuously. And we've seen, for example, the entry of supras, sovereigns, corporates, financial institutions issuing various types of sukuk. But the driver for that is not the actual demand from the fund management industry in the regions where Islamic finance is active. It is actually to attract the international investor. Yes, we've seen some of the governments trying now to adopt more of these milestones and strategies in terms of sustainability and green and environmental, but it's at an early stage. So a very important point that the key driver for the growth that we've seen in the sukuk ESG related issuances in the past 3 years is mainly driven by the international investor appetite and the intention of the regional issuers or local issuers to attract that investor rather than attracting the their own regional or local investor that is Sharia compliant. And that's a very important one. Do we expect this trend to continue? Yes. I mean, actually, now, if we look at our rated portfolio of Sukuk, which is around 135 billion US dollar outstanding, 10% of that is ESG related. That's significant. But if you look at the bigger picture, so out of the whole outstanding ESG related sukuk to the outstanding sukuk, it continues to be less than 5%. But the potential of that is there. The drivers are there. We expect it to continue. And maybe over the medium to long term, it will become a substantial part of that bigger outstanding sukuk issuance in general.
I just want to more close this conversation to some of the risks and opportunities that might lie ahead. Maybe Bashar, you can cap this conversation off in terms of what are the 2 or 3 kind of risks that you're particularly concerned about for this year before we move on to Alastair.
I mean, as a rating agency, we don't get concerned. We look at it independently. But what we're looking at is definitely in terms of each of the industries. So whether the Islamic banking industry, the sukuk industry, or the takaful industry. So maybe when we're looking at the Islamic banking industry, it's definitely the asset quality, MPLs, the profitability, the growth, and liquidity. And in many of the markets where Islamic finance is active, the liquidity is intact. Yes, there will be pressure on the profitability and NPLs, but we don't expect that to be significant, and that's a general theme, but it is something definitely to watch. On the sukuk side, I think if you look at issuance, we expect it to continue, but there is a lot of factors that actually could put that in hindrance. So whether a geopolitical risk, whether it is the international investor appetite to the industry, or a reputational risk that you can have the industry performing in a different way in a case of default where it will shake the confidence. Lack of standardization, I mean, we've talked about that many times before. I'm not going to go through that route, but it definitely continues to be one of the key limitations and challenges that the industry it's going to be facing, and it will continue to. The takaful side of things, I think it continues to be small, and mainly because of the awareness of I'm not talking about Malaysia, but in other countries, about the awareness for insurance in general and their cultural standing towards insurance, let alone takaful. That is something that needs a lot of work and a lot of government policies to push, but we're seeing that happening specifically with COVID. The awareness has increased, but again, it will continue to be a limitation for that specific sector. And I'll leave Alastair to talk us about.
Go ahead, Alastair.
Yeah, I mean, when we think about rating mutual funds, really the 2 key themes for this year are, number one, the asset quality of the fund, and that's obviously affected by many factors. We've seen, for example, the escalation of the issues between Russia and Ukraine have had an effect on multiple stock markets around the world. This is an asset quality effect for mutual funds. And then the other major macro theme is the tightening of policy rates and the unwinding of the Fed's balance sheet, which has an effect which is felt globally, both in terms of the direct effect of rising rates on bond prices, but also more broadly on economic conditions. So these 2 themes of asset quality and the effect of tightening in the US and various other markets being felt globally will be very significant to our rating view of mutual funds during the course of 2022.
Alastair, do you feel a little bit more optimistic for 2022 compared to previous years, or do you still move ahead with, I guess, a sense of caution and perhaps still too many things are still uncertain right now?
As a well-trained credit analyst, I've been trained over many years to always look for the downside. So I'm obliged to see the downside. But no, obviously it's more important to be right than to be conservative. Now, I would say we are quite possibly at the high watermark in terms of quality. I think the effect of inflation, I think the effect of a rate cycle and the risk of policy misstep, the geopolitical issues that I've already alluded to, these create a very clouded macro outlook, very clouded macro picture, which will obviously have different ramifications in different markets depending on their idiosyncrasies. But I think there are major and known issues in the market at the moment. There's always the risk of unknown issues as well. So I'm inclined to say that the outlook for the rest of the year for mutual funds is at best clouded, but with the potential for downside risk.
So, Bashar, I guess you have to take the default position of being optimistic. What do you think?
I mean, the thing is, optimistic, it depends on what you're looking at. So if you're looking at like growth as one of the elements, so do we expect the industry to grow? Yes. But if you look at the asset quality, if you look at the NPLs, if you look at the challenges and the downside risks on the credit side of things, I think it is definitely more challenging. But I think, as Alastair alluded to, I think we've already reached a peak. Yes, we're still going to be seeing challenges in terms of that, whether you're looking at more on sukuk defaults, whether you're looking at the NPLs in banks and its quality, whether you're looking at the takaful industry being more challenged in its quality of underlying or investment that they're investing in. So all of that is going to be there. But in general, I think maybe we're at a peak, but things could change. And I think this is what we're trying to also highlight. As we've seen in the past few years, things could go backwards, could be paused, could be heightened very quickly. So it is something that we're watching closely. In terms of growth numbers, I would say, yes, we're expecting a continuation of growth. In terms of the credit matrix of many of the stuff that we're looking at, so if you bundle them all together, sukuk, bonds, Islamic banks, takaful companies, I think the credit side continues to be challenged one way or other, specifically with the removal of many of the government supports that was installed during the pandemic.
Of course. Okay, gentlemen, thank you very much for spending time with us. That was Bashar Natoor, Global Head of Islamic Finance for Fitch Ratings, dialing in from Dubai. Earlier on, you heard from Alastair Sewell, the Senior Director and Regional Head of Fund and Asset Manager Group of EMEA and APAC region of Fitch Ratings. If you've missed any part of this interview, just head on to astroawani.com, look for Notepad there. You can also search for Fitch Ratings reports and write-ups at fitchratings.com. Catch you in the next one. Thank you very much for joining. My name is Ibrahim Sani. Goodbye.